I think it's offsets to all the good news. I think that's been the story of the year, really. The S&P 500 is up less than 2% since the end of January. Let's keep that in mind. And so what the market's project has been all year is figuring out how long the good can last and what the offsets are. The offsets in the form of higher rates, higher cost of corporate debt. I don't think it's about people bailing on the bond market for stocks. It's about the cost for corporations going up. So I do think this is an adjustment. The stock bond valuation ratio is kind of stretching the cycle highs. And I think the market just has to come to some kind of terms with this new level of yields if they stay here.
And Erin, as we head into Q3 earnings, what are you watching right now in terms of the growth targets and what could happen now in light of the stock move today?
So a couple of things. There's some big hurdles for a few sectors, and Q3 can be one of the hardest for them. Financials is expected to have earnings growth by 40%, and they've been lagging for most of the year. So some of the higher rates, but while the spreads are still small, that could be really tough and be a drag on the market. Tech has a slightly easier hurdle of about 22%. But I think one of the things that we've been looking at is the beat rate recently has been over 80%. So now the expectation is 80% of all companies beat their earnings and beat their revenue targets. And that just makes it even that much harder. So if we are going into an earnings season where valuations are a little on the higher side, and right now we're still pretty healthy, but that could certainly be some worry because it's just people are used to having these very high growth rates and very high beat rates.
Mike, I'm taking a look at the tech stocks that are doing the worst this morning in early trade. Roku, Atlassian, Chegg, Shopify among them. Smaller stocks, stocks that are perhaps seen as a risk. Investors might have been putting money in for growth. Is that what you would expect to see given what we're seeing in the bond market?
I think the ones that have run a lot, that basically people have good profits in. I don't think it's a direct kind of bond market knock-on effect to those particular companies, but it is about, okay, risk appetite's ratcheted down a little bit. And tech in general has become a narrower story, right? It's been mostly software. It's been some of the huge platform companies. You kind of lost semiconductors as a leadership group. You've sort of lost other areas along the way. And so I do think those smaller cap kind of junior varsity internet names that had a lot of people with a lot of speculative interest in there, they're backing away.
Meanwhile, on consumer, NRF comes out yesterday and says for the holiday season 4.3 to 4.8, which would be well above trend.
Yep.
Biggest losers this morning are Estee Lauder, Under Armour, Tapestry. I mean, how do you square that?
You know, we've seen this already in the consumer discretionary. Some of those consumers actually have been just killing it. They've figured out inventory management, they've gotten their margins under controls, and some are still behind in basically the new economy of online shopping.
Namely Amazon.
Namely Amazon. But we have seen, look, we've had some great returns with Nordstrom's, Macy's, some of your big box retailers that really have turned around.
But broken down to some degree, right? I mean, Macy's as an example.
Yeah.
Is coming off 33 versus 41 a couple of months ago.
Yeah, so they had that run up and then they've come back down. We still see this fourth quarter as a real area for some of the consumer discretionary stocks to come back and bounce back big. But they're well valued. They've got some great growth rates, easier comps, and better inventory management.
And so, Mike, what are you watching right now as the key factors that will determine whether we see a pullback in October?
Yeah, I mean, that could be kind of what amounts to a little bit of a pullback right now. We've had this stealth pullback in lots of sectors and small caps and things like that. Now, it's a little bit less stealthy with the Dow down 200 points right now. But I am also watching the emerging markets dynamic and the dollar, because if you look at that chart of emerging market stocks, it starts to look like a 2-week bounce in a pretty big downtrend as opposed to a revival. And that could complicate the story. I honestly still think that the U.S. big cap indexes, the uptrend remains kind of intact. We haven't undercut anything important just yet. The credit market remains okay, but the cost of credit is going up. So I think that's why it's a sector-based thing. By the way, the economy, too, you talk about the retail, this market is separating everything, the whole world, into disruptor versus disrupted. And the disrupted stuff starts to look cheap and nobody cares. And it sits there like old retail, like autos, like some financials for that matter, asset managers. And that's an interesting thing I don't think is going to change very soon.